Hey, welcome back. My name is James Johnson. I've been a wealth advisor since 2003. My expertise lies in retirement and estate planning. And what I'm going to talk to you about today is I'm going to talk to you about if you could grow your money tax free, access up to 85% of it at any time tax free, put it back if you want, get most of the gains of the market, never participate in the losses, and when you died, it passed on to 2 to 3 times that amount tax free. Would you want to do that? And the answer is yes, I'd want to do that, James. I would want to do as much as I possibly could in that environment. So what that is that's a properly maximum funded life insurance policy under TEFRA, DEFRA, and TAMRA. Now, if you understand these things and you understand how to do this, it gets relatively simple. However, very few people in this industry really understand how to do it correctly, and it's very easy for me to see quickly whether it was done right or wrong, and I'm going to show you that today. So the first thing we have to do whenever we're going to do any kind of a strategy using life insurance is we have to decide which strategy is going to be. Now, we might be doing a very advanced planning strategy if you have a lot of money and your income's very high, where we're doing something called premium finance. We might just be doing a plain old vanilla death insurance policy using term insurance or a whole life policy or some kind of permanent life insurance policy, or we might be doing what's called maximum funding that life insurance policy without doing premium finance and just doing it with our own funds. But if we're going to do it with our own funds, we need to make sure that we have the funds it takes to do that. And we need to go through and get a really solid plan, because this stuff works every single time. When it doesn't work is only because, one, it wasn't designed correctly, and two, it was never funded the way it was planned to be funded. If you follow a correct design and you fund it correctly, the results are astronomical. You do get to grow your money tax-free, access up to 85% of it anytime tax-free, put it back if you want, get most of the gains of the market, never participate in losses, and when you die, it passes on to 2 to 3 times that amount tax-free. So what I'm going to show you here is a 57-year-old female. She's over here. Her income is $41,000, $42,000 a year. She's got about $20,000 coming in rentals. She's going to get Social Security at 62. She's got pensions coming in at 62. Her goal here is to retire at age 62. She's got some qualified money over here in an inherited IRA. She's got a 401k over here. She's got an IRA over here with Wells Fargo, and another IRA over here, another brokerage account over here, another brokerage account over here, and checking and savings. And her world looks something like this. So basically, she's got most of her money over here in the yellow tank, or what we would call the risk tank, and very little of her money over here in the safe tank. Now, in addition to that, if we look at her asset allocation, what we find is that most of her money is in high risk, a little bit of money over here in low risk. Down here in tax-free is her house, but other than that, she has nothing in the tax-free bucket. And so tax-free is only her house. Most of her money is in tax-deferred, and some of her money is over here in tax as she goes. Now, her goal is to get as much money out of risk and over into safety, and out of tax-deferred and tax as you go over into tax-free. But when we look at her cash flow and we look over here, we can see that what she needs to live on per year is about $61,815. And we run her numbers out here. We can see that we're saving all of the excess out to the checking account. And the reality is that she's spending every dime that's coming in the door. So if we were just going to look at it from that standpoint, she could not go out and reroute any money over into tax-free, because the reality is that she doesn't have any money to contribute to that. She's living on every dime. But she's got a very good opportunity here, and that is this inherited IRA. If she continues doing what she's doing right now, then she has to take what are called RMDs, required minimum distributions, that she has to take out of that IRA every single year, and she has to distribute it 100% out over the next 10 years with the current laws. If she managed to get it before the current laws, she could stretch it over a lifetime. But either way, she's going to have to take that out every year. Even though she's under 59 and a half, she can be taking out as much as she wants from that inherited IRA without a 10% penalty. So this affords us with a very large opportunity. And the opportunity is to start distributing that IRA and getting it out to tax-free. Now, because it's an inherited IRA, we can't convert it to a Roth. So her next best choice is to put it in a life insurance policy, and that would be a properly maximum funded life insurance policy under TEFRA, DEFRA, and TAMRA. So what we did is we went over here and we went out and we created an account over here called the maximum funded life insurance policy. And in a second, I'm going to show you that illustration and I'm going to show you how that works. So over here, this was the income, the money that we rolled out of the IRA and put it over into tax-free so that later on down in life, we can start drawing this money out 100% tax-free and it won't even show up on our tax returns. Is we're going to go and we're going to look and see how did we design this policy. So the way this policy was designed is you can see here a number called Guideline Single Premium. Right here, this number, initial guideline single premium. And we determined that what we wanted to do is we wanted to reposition $200,000 out to a tax-free environment from a tax-deferred environment. By doing that, we buy the least amount of insurance, and you'll notice that this number does not equal in zeros, and it's $447,140.97, and it's level. Now, what that means is according to the law, I can put in $40,339.21 per year, starting on day one, and then each year after that, until I maximum fund this policy. Now, if I do that, it looks like this. So I go over here, let me pump this up a little bit so you can see it a little bit better. And you can see over here that what I have is I have $40,000 going into this policy. Now, when you're looking at this illustration, it can be a little bit confusing if you don't understand what you're looking at. So anytime you see a guaranteed value, that's what would be called the CYA form, cover your ass and they don't mean yours. So what they're showing here is that the market goes down every single year for the entire time you own the policy. Now, a little piece of news for you. If the market goes down for 4 years in a row, you need guns and bullets, and it won't matter where your money is. So that's not a realistic situation. In addition to that, they have over here a 2.05% rate of return on the policy, and the fixed rate account is actually higher than that. So doing that doesn't make a lot of sense either. And you can see over here, the illustrated rate on this is being illustrated at 6.24%. So the column we really want to be paying attention to is this column, the blue column on the side, which is our current non-guaranteed column. You notice that we put in that $40,339, and at the end of the first year, we only have $36,863 working for us, and we have a cash value of $18,530. Now, if we looked at that, that looks pretty bad, if you ask me. I had $40-some thousand here that I put in this policy, and all of a sudden I only have $18,000 in liquidity. Well, there's a reason for that. The insurance is going out on the hook on a very high level here. And the reason why is because the day she writes that check and signs for receipt of that policy, if she walks out the door and gets run over by a car, the insurance company has to pay her heirs $447,141 immediately in tax-free income. So they went out, they issued contracts, they did physicals, they bought options, they paid commissions, they did all of the expenses to make this happen, and then suddenly they get hit with this huge fee on top of that. That's a problem for them. Now, they do have $36,000 working for them, but their liquid cash is only $18,000 is because if they said right now, give me all my money back, the insurance company's not going to eat all of those expenses. They're going to leave it up to the client. So it's very, very important that if you do something like this, that you do it properly and you fund it. So basically, I always put an analogy in of you're buying a 5-story building. And if you had a 5-story building, would you ever buy a 5-story building and rent 1 floor and then leave it empty, or 2 or 3 floors and then not rent the last 2? And the answer is no. You need to fund it all the way up because there's a drag on it, and that's the cost inside the policy. And that is what's keeping your cash values down so low. So notice here in the second year, we put in 40,000, third year 40,000, fourth year 40,000, and this is actually the first day, 1 day, 1 year, 1 day, 2 years, 1 day, 3 years, 1 day, and 4 years in 1 day. We've actually maximum funded this policy with that $200,000 guideline single premium. And as you can see over here, what happens is here we are, there's 40,000 at 36, 76 at 80. Here's 120, 117, 160. We're now head above water. And by the time we get out here, the money that we have put in is more than what we actually have put in. Or the money we have is more than what we put in that's actually working for us. But our cash value is not head above water until the 6th year. So the reality is one of the bads of building one of these life insurance policies is it takes a while to get it funded and then get it really going. Now, if you look down this column, you'll have over here accumulation value and a cash surrender value. And each year you'll see that those numbers get closer and closer together. And in the 15th year, there is no longer a surrender charge, and those numbers are one and the same. So as we go down here, it will continue to grow and grow. And as the cash value gets closer to the death benefit, then the death benefit will actually start to grow. And all the way out here at, let's see where age 100 is, that's age 87. If she never touched this policy, by the time she got out here to age 100, her death benefit would be $2,142,000. But notice the cash value and the death benefit are one and the same at this point. Now, why did we build this? And the answer why we built this life insurance policy is because what we were doing is we were building a tax-free bank account that we could access at any time. And that is what this number is here. Oops, right down here, this column is our tax, well, it doesn't seem to want to let me do that. But this column here, our cash surrender value, is our bank account. And we can access up to 85% of that at any time. Now, we do videos on how to access money out of a life insurance policy, but just know this, there's a sad way, a dumb way, and a smart way. We're going to use the smart way, and that's using what's called policy loans. But that's for a different video for you to see later on. Go watch that video on how to access money from life insurance policies. Now, going back here, what we have now is we have this, but then what we want to look at is we want to look at, okay, well, what was our other purpose for doing that? And that was to actually get some cash flow out of it. So now we're going to look at it using the cash flow feature out of it and using the loans at a later date. So when we go down here, what we'll see is that we've funded up this policy. We funded up this policy, and now we start taking out policy loans from the policy. So over here, we've put in a total of $200,000, and starting out here at age 72, she's going to start withdrawing $27,414 per year, every year for the rest of her life. She gets out here at age 100, and when she dies, she's taken out policy loans for a number of years of $27,000, and she dies with a death benefit of $91,000 left in here. So this is how this policy worked. Let's go take a look at a couple of others. So that was our policy loan on that one. All right, so this is our second test case. And what you're going to see in this particular case is we've got a 43-year-old female this time. And the difference here is quite dramatic, all right? In this particular case, this person is doing very well. They're making about $400,000 a year. And they're going to work all the way out to age 64. And their only known income in retirement is going to be their Social Security. They've got about $20,000 in checking, $150,000 in their brokerage account, and $300,000 in their 401k. Now, we've checked, they can't do an in-service distribution in their 401k at this point. So we're looking to find out, okay, well, what could we save out to tax-free? And we don't have a lot of money over here to do that. So where would we get it from? So we look over in our cash flow, and we can see that she's living on $128,000 a year, and she's saving a considerable amount of money to her future, about $152,000, part of which is included inside of her 401k. So we take a look at where she's saving it, which is into her brokerage account, and we can see that she's saving $120,000 a year on an average, and then working down from there, because inflation, her job is only inflating by 1%, but inflation is inflating by 3%, so she's saving less money each and every year. So we take a look at that and we say, okay, well, what's her allocations look like? So we go back over here to her allocations, and we can see in her allocations that almost all of her money is in high risk, and this wouldn't be abnormal for somebody that in their 40s to have all their money at high risk. They can afford the risk because if something goes bad, they just wait, it'll come back. But most of their money is over here, either in the taxable account or in the tax deferred account. So where does she want to be? She wants to be down here in this tax advantage or tax free, but how much can she actually contribute to a Roth IRA? And the answer for her is 0. She can make 0 contributions to a Roth IRA, and she can't convert her 401k because she can't do an in-service distribution. So that leaves going into a maximum funded life insurance policy. So in this case, we had about $120,000 a year that we could work with. But over here, what we did is we figured out that her guideline single premium here is $194,517, and her level premium or 7-pay is $49,573, but her level premium is $36,000. Now, this one's a little bit different, so pay close attention here. Notice that the death benefit doesn't end in zeros. It's right here. This is the least amount of insurance that we can buy using this guideline single premium. But this time, we're going to use an increasing. So what we're going to do is we're going to add a level to the building every single year going forward so that she has more and more room to put money in this policy. Our most important number on here is our guideline single premium, because once we hit that number, we could choose to stop doing this, but we must do that guideline single premium because that basically is our 5-story building. So going down here, we're going to take a look at what actually happens by doing that. And what she's going to do now is she's going to be funding $36,000 a year, but she's going to keep doing that for 22 years. So she's going to go all the way out here, and by the time she gets here, she's going to have put in $796,000 inside of this policy over that period of time. Not much has changed. You can see pretty much the same things going on here where $36,000 went in. She's got $33,000 and $12,580. Now, it's not as close to the cash value as the accumulation values because we're not putting in every single dime that we could in that first 5 years because we're leaving room to put more money in. So we've put in 180. We're pretty much head above water here. We put in 210. We're head above water here. So we're kind of on the same track we were. Our surrender cost goes away in the 15th year, just like it did before. But now, real quickly, remember, why did we do this? We did this so that we would have access to this cash inside of here, tax-free, anytime we want. And we can do that through what's called policy loans. So we could go out right here and we have $500,000 in here. If we wanted to go buy a house, we could go pull out $400,000 right there, go buy a house, use that money, and then when we wanted to, we could put it back. But if we went out there at 54 and we pulled $400,000 out of our Roth IRA, could we put it back? And the answer is no. People say, well, you can't pull money out of your Roth IRA. Well, actually, you can. You could pull out any contribution you made to your 401k at any time. You just can't put it back any more than what your limits are. And remember, she couldn't do a Roth IRA anyway. So in this case, the reason why we're doing this is to build this maximum funded policy and be able to access our money anytime we want. Now, you'll notice also in this case, what's happening is this bar is making me crazy, is her death benefit is also going up over time. So as we go here, her death benefit is increasing every single year because it needs to increase to have more space inside the bucket to put more money. So we slide down here, and when we stop funding this policy over here, we stop funding the policy right there at the 65, you're going to see an immediate decrease in the death benefit. So we did what's called levelizing this policy, and we dropped the death benefit from that $2.2 million down to the $2 million right here, and then it's going to go back to growing again. So we could do that at any point in time that we hit guideline single premium. Now let's go back real quickly and let's talk about a couple of things here. Remember that we're maximum funding this policy. So if we're maximum funding this policy, then there is always going to be enough money over in our cash value to fund the policy should we need to skip a year. So if we chose that, say in the 4th year, we didn't have enough money to put in, we literally could wait till the next year and catch up that premium. So rather than putting in $36,000 in the next year, we could put in 72 or possibly even more because our 7 pay is a little higher than that. Now, hopefully this is getting you to understand how these illustrations work and how maximum funded life insurance policies work. But I think the most important thing for you to understand here is you don't just run out and do this. You've got to have a really solid plan to do it. It's got to be designed correctly. And if your policy's ending in zeros, you can pretty much bet it was not designed correctly as far as maximum funding the policy goes. So you need somebody that knows the tax laws, knows how this works, knows which strategy is going to work best for you. And the only way that's ever going to happen is if you sit down and do a clear, comprehensive plan of what your retirement looks like going forward and figuring out, does maximum funded life insurance work in your exit strategy? And can you live with the bads and make all of this work for you? If you can, there's not a better way to build a tax-free retirement account. Hey, listen, remember to go out, subscribe to our YouTube channel, and be sure to go watch other videos on this subject. There's a whole series of them that you can watch on life insurance, and I look forward to seeing you in the near future. Remember to live like you're going to die tomorrow and plan like you're going to live forever. Keep smiling and make it a great day.